This lecture is presented by John Moffat of Open Tuition. For other free lectures, visit opentuition.com. Okay, we're going to go through the Payback 9 June 2015 exam. So make sure you've got the exam in front of you. You can download it from the ACCA website. And first of all, let's go through section A, the multiple choice questions. And although obviously to make sense of it, I'll go through them in number order. Do remember in the exam to, what you might say, jump around. As soon as you come to a question that looks difficult, it's a topic that you're not happy with, or there's an awful lot to read, jump over it. You can come back to it later. Go through the short ones. Again, the ones you feel, topics you feel confident on. Go through them, then come back and do the longer, the harder ones. And make sure that you do hand in 20 answers, even if it means guessing ones you can't do or you don't have time to do. Guess them. If you get 5 questions, you're likely to get at least one right. And it's only 2 marks, but if you were otherwise failing on 49, obviously 2 marks is enormous. Anyway, let's start going through. As I say, I'll do them in number order. So first of all, question 1. And it's a fairly quick one. There's not a lot to read. You either know the answer or you don't. If you don't, guess it. There's pointless wasting time. But it says, which of the following statements is or are correct? Number 1, monetary policy seeks to influence aggregate demand by increasing, decreasing the money raised through taxation. No, that's fiscal policy when we're looking at tax. Number 2, when governments adopt a floating exchange rate system, the exchange rate is an equilibrium between demand and supply in the foreign exchange market. Yes, with floating rates, the rate adjusts to keep a balance between supply and demand. So number 1 is not true, number 2 is true. And in fact, if you look at the choices of answers, although I'll read the third, we now know which is the right one. 1 isn't true, so it's not B, C, or D. The answer has to be A. Let's just check number 3, but as I say, in the exam you'd be wasting time. Fiscal policy seeks to influence the economy and economic growth by increasing or decreasing interest rates. No. That effectively is monetary policy. So the answer is 2 only. The answer is A. Let's move on. Number 2. Sorry, let me get my mouse here. Number 2. Which, again, it's which of the following is correct. So, yet again, a fairly quick one, whether it's, you know the answer or whether you're guessing. Number 1, the general level of interest rates is affected by investors' desire for a real return. Yes. It's the rate they require that helps determine it. Number 2, market segmentation theory can explain kinks, discontinuities in the yield curve. Yes. Look at Untitled Chapter 1 in the lecture notes. Mentions market segmentation. And 3, when interest rates are expected to fall, the yield curve could be sloping downwards. Yes. More likely it tends to slope upwards. People are expecting rates to increase. But anyway, if they're expected to fall, it could be sloping downwards. So all 3 are true. The answer is D. And here's the first one with any calculations. We've got some information there. We've got the earnings per share, the dividends per share, the share price at the start of the year for each of, 4 years. And he says, which of the following statements is correct? Well, no choice. We're going to have to go through them one by one. First of all, A, the dividend payout ratio is greater than 40% in every year. Well, the dividend payout ratio is the dividend as a percentage of the earnings per share. So in the year 0, the dividend was 13 on earnings of 30. So in percentage terms, 43%, which is fine. We're above 40. What about year 1? Dividend 13.2 on earnings of 31.8 in percentage terms. 41.5%, so again we're okay. Time 2, 13.3 over 33.9. It's 39.2%. Well, that's below 40, so there's no point in carrying on with the last one. It's not A. What about B? The mean growth in dividends per share, the average growth is 4%. And you should be happy from your studies of working out the average rate of growth. I can't give a full lecture here. If you need, watch the free lectures. But here, over the entire period, it's grown from 13 up to 15, the dividend. And how many years of growth have there been? 0 to 1 is 1 year, 1 to 2 is 2 years, 2 to 3 is 3 years, so there's been 3 years growth. And so very standardly, the average rate of growth, it ends up at 15, it started at 13. We take the cubed root because there's 3 years growth. Minus 1 gives us 15 divided by 13, the cubed root. Less 1, I get 0.0489 or 4.89%. Well, the statement said it was 4%. It isn't, and so the answer's not B. What about C? The total shareholder return for the third year is 26%. Well, to get the total shareholder return, you take the dividend, which is 15, but appreciate its cents. So if I keep the dollars, the dividend was 0.15, together with the increase in the share price. Well, the share price, it ends up at $225. It was $2.01. So an increase of, 14 cents or $0.14. So the total they've had is 0.29. The return we express as a percentage of the initial share price of 2.01, which is 0.29 divided by 2.01. I get 14.4%. Well, it's certainly not 26%. It's not C. So, of course, the answer must be D. What I do, because of the time pressure in the exam, I would mark D, but I put a little mark on the question paper that if I had time at the end to come back and check, we could have made a mistake on ABC. However, let's check D here. The mean growth in earnings per share is 6%. Well, exactly the same approach as we did with dividends. So over the period, it ended up at earnings at 35.7. It started at 30. There's 3 years growth, so the cubed root minus 1. And what does this give us? Cubed root minus 1. I get 0.0597 or 5.97%. Well, it's not exact, obviously, but it's as near as it could be at 6%. So the answer is D. Number 4, another what I call written. We're not writing, but I think you know what I mean. But a fairly quick one. Which of the following statements is correct? One of the problems with maximising accounting profit as a financial objective is that accounting profit can be manipulated. People can fiddle, can cheat the accounting profit. Things like bringing in or leaving out accruals or changing the rate of depreciation or something. We can manipulate it. So in fact that is true. It's fairly standard. That's A. Again, I'm confident I will go straight for A and leave it, but let's look at the others. A target for a minimum level of dividend cover is a target for a minimum dividend payout ratio. No, they're actually the other way around. Dividend cover is earnings per share over dividend. Dividend payout ratio, well, from the previous question, the payout ratio is the dividend as a percentage of the earnings per share. So they're the opposite, if you understand me. So it's certainly not B. C, the welfare of employees is a financial objective. Certainly, it sounds to be an objective, but it's not financial, how well they're looked after, so it's not C. And finally, D, one reason shareholders are interested in earnings per share is that the accounting profit takes account of risk. Well, it doesn't. The profit's the profit. They may be interested in the profit, but it's certainly in itself nothing to do with the risk. So I was confident anyway, but the answer is A. 5. Which of the following statements is not correct? Yet again, statement 1. Be careful here. He's trying to trick you with the wording. A, return on capital employed can be defined as profit before interest and tax divided by the sum of shareholders' funds and prior charge capital. It's nearly right, except return on capital employed, it's profit after interest and tax. So it's not A. B, return on capital employed is the product of, the multiple of, net profit margin and net asset turnover. Well, again, it's nearly right. But if you check back with the notes, the lectures, it's the product of the operating profit margin and the net asset turnover. So it's not B. C, dividend yield is dividend per share divided by the ex-dividend share price. Well, again, that's nearly true, but they quote dividend yield on a daily basis, sort of thing. So it's whatever the current share price is, whether it's ex-dividend or it isn't. So it's not C. Return on equity can be defined as profit before interest and tax divided by shareholders' funds. Start number 5 again. All right, let's go on. Number 5. And of course, another statement 1 here. And be careful, it says which of the following statements is not correct. So 3 of them are correct and 1 isn't. Let's read A. Return on capital employed is profit before interest and tax divided by shareholders' funds and prior charge capital. Yes. Standard definition. It's all covered in the notes and the lectures. B. Return on capital employed is the product of net profit margin and net asset turnover. Yes, very standard. It's the 2 together. C. Dividend yield is dividend per share divided by ex-dividend share price. Yes, dividend is a percent of share price. So these are all correct. What about D, though? Return on equity is profit before interest and tax divided by shareholders' funds. No. Return on equity, it's the profit available for shareholders, so the profit after interest and tax as a percent of shareholders' funds. So D is not correct, and therefore the answer to the question is D. Okay, that's 5 done. Let's have a quick break and then we'll do the next 5. Okay, well, I'm working through the June 2015 paper F9 exam. We're doing section A, I've been through the first 5 questions, so let's now look at question 6. Yet again, a statement one. So many in this paper. We've only done one calculation, I think, so far. Which of the following statements are correct? The sensitivity of a project variable can be calculated by dividing the project net present value by the present value of the cash flows relating to that project variable. Well, that is correct. That's the way we calculate sensitivity. I said earlier, I can't give full lectures here, that would be silly. If you need to, everything's covered in the free notes, the free lectures. But that's the way we do it. Statement 2. The expected net present value is the value expected to occur if an investment project with several possible outcomes is undertaken once. No. If there are several outcomes, if the answer could be 100 or 200, do it once and it will be either 100 or it'll be 200. The expected value is effectively the average, and that would only be relevant if it was repeated and repeated, sometimes 100, sometimes 200. So it's not 2. Finally, 3, although if you look at the choices, we now know the answer. But anyway, discounted payback period is the time taken for the cumulative net present value to change from negative to positive. Yes, it's not an obvious way perhaps of writing it, it's easier to see with figures. But you've got the outflow, you've got the present value of the inflows, and it's when the present value of the inflows equals the outflow, the net present value is 0. Earlier, NPV is negative, later positive. It's when it changes. So number 3 is correct. It's 1 and 3. The answer's B. 7. Oh dear, another one. Which of the following statements is or are correct? Number 1. The asset beta reflects both business risk and financial risk. No. That would be the equity beta. The asset beta ignores the gearing, the financial risk. It's only measuring the risk of the business itself. And then number 2, total risk is the sum of systematic and unsystematic. Yes. Systematic risk, the risk in the world at large, the stock exchange as a whole. Unsystematic risk, risk peculiar to each individual company. But the total risk is the 2. 3, assuming that the beta of debt is 0, will understate financial risk when ungearing an equity beta. Now, I don't like this. It takes a while to think it through. And I think the best way is, if you look at the formula sheet, you should know, even though we're not doing numbers here, that to get the asset beta, you've got the formula. The asset beta is VE over VD plus VE1 minus, VE plus, VD1 minus T times the equity beta plus VD1 minus T over VE plus VD1 minus T times the debt beta. So it's a bit scruffy there, but you've got the formula sheet. Now, usually in any calculation question, we assume the debt beta is 0. And so the asset beta is just that bit there. Now think about this. Again, I can't do a full lecture, but the asset beta is always going to be smaller than the equity beta. The equity beta, the share is riskier because there's gearing. This formula effectively takes out the gearing, and you end up with a lower asset beta. Now, if you assume the debt beta is 0, you've only got this bit of the formula. In real life, of course, the debt beta, although it'll be small, there is an element of risk. And so you would have a bit added on. So, I'm making up figures here. Suppose this bit of the formula came to 0.8 and this bit of the formula came to 0.1. You'd end up with 0.9. However, because we assume it's 0, we ignore that bit, and we'd have ended up with 0.8 instead. We'd have had a lower asset beta. If we assume the debt beta is 0, the asset beta will be lower than it really should be. And what does that mean? Well, getting a lower asset beta than we should do means we've effectively taken out more financial risk than we should do. And therefore, what did the statement actually say? I've lost it. And therefore, if we've assuming it's 0, we've understated the financial risk. And so the answer to 3 is not true. And so which of the following statements is correct? It's 2 only, which is A. Okay. What about number... What was that, 7, 8? Which of the following statements are correct again? Share option schemes always reward good performance by managers. No. I mean, that's the aim of them, to try and get managers to perform well. But it doesn't always reward good performance. They do well if the share price goes up, and it can go up for other reasons than good performance by the managers. Number 2, performance-related pay can encourage dysfunctional behaviour. That is true. Wait a minute. Sorry, I did say the right thing. It isn't true. It doesn't always reward good performance, even though that's the intention. So 1 wasn't true. Number 2, performance-related pay can encourage dysfunctional behaviour. Yes. Again, if the rewards are designed well, we hope they'll perform in a way that's good for the company. But that's not always the case. If it's not designed well, what's good for the manager, gives them more pay, is not necessarily always good for the company. So it can encourage bad behaviour. I'm saying it does encourage it, it just can if it's not designed well. Number 3, value for money as an objective in non-for-profit organisations requires the pursuit of economy, efficiency and effectiveness. Yes, very standard. The 3 sort of measures of value for money, the 3 E's, economy, efficiency, effectiveness. So it's 2 and 3. The answer is C. Number 9, which of the following are financial intermediaries? Financial intermediaries, effectively between me as an individual and the final investment. Venture capital, yes. I might invest in a venture capital organisation. They then invest all our money in companies. Similarly, a pension fund. We'll have our pension money in this fund, but then the total is invested in different businesses. And similarly, a merchant bank, same idea. So all 3 of them are financial intermediaries. Put our money individually into these 3. They take the total and invest elsewhere. So it's 1, 2 and 3. The answer is D. 10, at last, another calculation one. A company has in issue loan notes with a nominal value of $100 each. Interest on the loan notes is 6% per year, payable annually. The loan notes will be redeemed in 8 years' time at 5% premium to nominal value. The before-tax cost of debt is 7% per year. Well, pretty standard. Remember, the market value of loan notes, bonds, debentures, the market value is the present value of the future expected receipts, discounted at the investor's required rate of return. So at $100 nominal, what receipts will the investor be expecting? They'll be expecting interest, 6% a year, so $100 nominal, $6 per annum, every year until repayment, so years 1 to 8. At the end of 8 years, they'll expect the repayment or the redemption. It's 5% premium to nominal, so a nominal of 100. They'll be getting 5% more, 105. So they are the expected receipts. Their required return is the before-tax cost of debt, which is 7%. We'll discount at 7%. Now, I'll do the arithmetic, but that's standard. We'll use our tables. But here, you hadn't much choice. You had to discount at 7, whether you understood why or not. But do appreciate it's investors determine the market value of debt. So it's what the investor expects to receive, discounted at the investor's required return. Tax is irrelevant. And you're looking at the cost to the company, they get tax relief. You take the after-tax interest. You would be concerned with the after-tax cost of debt. But for the investor, tax is irrelevant. Everything's pre-tax. And so just standard discounting, you've got the good discount tables given you obviously in the exam. So the annuity 8 years at 7% is 5.971. The ordinary discount factor for 8 years at 7% is 0.582. So if I multiply up 6 times 5.971, 35.83, 105 times 0.582, 61.11, what do I get? 94, 690, 6.94. Yes, that is one of the choices. The answer is B.